Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Today we are doing a deep dive into some recent analysis, and we're looking at two huge shifts that seem totally unrelated but are happening at the exact same time across tech and finance.
Right. And our mission here is really to pull out those key nuggets for you to understand where power and capital are actually flowing right now.
And that's really a theme, isn't it? Control.
It is. So for our first topic, we're looking at the physical world. Silicon, AI, hardware,
Sure.
specifically a contract rejection that, it just proves the control over pricing has completely flipped from the giants in Silicon Valley to the hardware manufacturers.
It's a historic seller's market,
Yeah.
absolutely, for the tools building the future.
Then we pivot. We'll go to the digital world, to Bitcoin. And we're going to examine some hard data that confirms this asset has.
Yeah.
It's completed a pretty profound transformation.
It really has. It's basically traded its original identity, the rebellious, decentralized project, for the stability and structure of a fully managed strategic asset.
One that's being used by massive corporations and even nations.
Yeah.
Okay, let's start with the physical world. That amazing power flip. Segment 1 is all about high bandwidth memory 4, or HBM4.
Yes. And this wild contract refusal that tells the whole story.
So for anyone who's a beginner investor, let's give some context. HBM4, what is it?
Okay. So HBM4 isn't just any memory chip. It is the absolute fundamental building block for the most advanced AI accelerators. We're talking about the massive GPUs that power models like Google's Gemini 3.0.
And when you say advanced, you really just mean speed, right? It's all about how fast you can move the data.
It is. This is memory that's stacked vertically. Think of it like a skyscraper instead of a single-story building. And that allows for just dramatically faster data movement between the memory and the processor.
And that speed is the key bottleneck for AI right now. If you don't have enough of this stuff, you can't build competitive AI. Simple as that.
Exactly. Now, in the traditional manufacturing world, a supplier like Samsung, they live for certainty. They love getting what's called a long-term agreement, an LTA, from a huge customer.
Like Broadcom.
Like Broadcom, an LTA guarantees volume. It means stable factory operations, guaranteed revenue for years. It's, the gold standard.
But the sources we looked at indicate that this time, tradition just got thrown out the window.
It did. Broadcom, which is the key partner supplying the AI accelerators for Google, specifically the new TPU V6 and V7 chips, they came to Samsung desperate.
They needed to lock in that HBM4 supply.
Desperately. They tried to guarantee purchases all the way to the end of 2028.
So 4 years of guaranteed money.
And Samsung unbelievably said no.
Just no.
They refused to lock in that supply past 2026. And this rejection from a supplier to one of its biggest customers is, it's virtually unheard of in the semiconductor world.
Okay, I have to challenge that a little. Broadcom is a huge buyer, a strategic partner for Google, walking away from guaranteed long-term revenue. That sounds like a massive gamble.
It does.
Unless you are absolutely certain you can make way more money later. What gives them that confidence?
That is the core question. And the analysis gives two very clear reasons. The first is just raw pricing power.
Okay.
They are completely convinced that HBM4 prices in 2027 and 2028 will be significantly higher than anything Broadcom would lock in today. So refusing the LTA now, it protects their ability to auction that capacity off later.
So it's like the analogy we talked about. If you're selling limited edition concert tickets and everyone wants them and a promoter offers you a fixed price for the next 4 years,
you walk away.
You walk away.
Yeah.
Because next year the price on the open market will be double.
Precisely. That's the dynamic. But the second reason is even more strategic. It's about capacity allocation. The data indicates Samsung needs to keep its manufacturing capacity, what they call KPA, available for potential orders from NVIDIA.
Ah, the NVIDIA factor. Of course. So why prioritize a potential NVIDIA order over guaranteed money from Broadcom?
Because NVIDIA's next-gen GPU platform, codenamed Rubin, isn't just expected to sell well. It's expected to utterly dominate AI demand for years to come.
And offer even higher margins per chip.
Much higher margins. So this isn't just about money today. It's a strategic alliance with the highest growth, highest margin customer in the entire sector.
It's a huge, calculated bet. Yeah. And it's not because they're having quality problems, right?
Not at all. The industry news confirms Samsung's HBM4 yield, that's the percentage of good chips they produce, is hitting what's called golden yield. They've closed the quality gap with their main competitor, SK Hynix.
So the quality is there. This is purely a market leverage decision.
It is, and the immediate takeaway here is that the supply shortage is not just severe, it's structural. The analysis shows 50% of Samsung's 2026 HBM capacity is already locked up for Broadcom and Google.
So that leaves the other 50%.
The other 50%, and that becomes a battlefield.
Fought over by who?
The giants, NVIDIA, AMD, AWS, all of them need this memory for their next-gen products.
Which creates a bidding war.
An absolute bidding war. The sources confirm it. We're at a point where the cost of HBM4 is basically, you name the price, we'll pay it. The producer holds all the cards.
So for you, the investor, listening to this, what does this signal about the semiconductor landscape?
First, this refusal is the strongest proof yet of Samsung's recovery and its control over pricing. This suggests a structural level up in their operating profit margin, their OPM, starting in 2026.
And that's a key point. They're not just selling more chips, they're selling them at a sustained premium. It changes the whole quality of their earnings.
Precisely. Which means current stock valuations probably don't reflect this yet. Second, the desperation from a company like Broadcom trying to lock in supply until 2028. That's the ultimate signal.
Right. It means this memory shortage isn't a temporary blip.
It's a long-term supercycle that will probably last until at least 2028, which reinforces the buy the dip idea for the whole sector.
And finally, it kind of reveals the AI arms race happening behind the scenes. Broadcom's move confirms Google's hardware business is thriving, but Samsung's move.
Samsung's move confirms that the market expects NVIDIA's Rubin chip to keep them dominant for the foreseeable future.
Okay, that's a fantastic look at the physical control shift. Now let's pivot. It might seem unrelated, but the unifying theme here is the concentration of power.
That's a great way to put it. In the AI world, power is with the producers of scarce hardware. In the crypto world, as we'll see, power has concentrated in the hands of the custodians, the people holding the keys.
A perfect connecting thread. Let's move to Bitcoin's great transformation, from this decentralized ideological project to a managed strategic portfolio asset.
And we have to start by acknowledging Bitcoin's original mission, right? It was to create a peer-to-peer currency, totally outside the control of banks and governments.
The dream of decentralization.
Exactly. And the recent analysis suggests that dream is, well, it's weakening, not because the code failed, but because the market structure just kind of absorbed it.
Right. The reality check is that today, market movements are overwhelmingly driven by these institutional whales.
Yeah.
We're talking Wall Street firms, JP Morgan, BlackRock.
And they aren't just participants anymore. They're acting as market architects. They're the ones dictating stability and access.
Let's use JP Morgan as an example. They used to be huge critics.
Fierce critics. Now, the data shows they're actively recommending Bitcoin funds to their wealthy clients. And even more importantly, they've become a core liquidity provider, an LP in the Bitcoin options market.
Okay, for the listener, what does it mean to be a liquidity provider in the options market?
It means you're providing the capital that lets buyers and sellers make their trades instantly. By being a core LP, they help ensure the market is stable. But if you look at the bigger picture,
It gives them influence.
a lot of influence. It lets them influence price movements and, you could argue, control the wild volatility that defined Bitcoin's early years.
It's like that gold rush analogy. A chaotic, wild frontier town slowly being replaced by a highly structured city where the big banks own the vaults and control the flow of gold.
That's the perfect analogy, and this institutional trend is accelerating. It's expanding beyond just finance firms into mainstream corporations and even sovereign wealth funds.
Let's talk about MicroStrategy, MSTR. They've basically become a Bitcoin bank.
That's a great way to describe it. The sources detail how they're issuing massive amounts of debt through things called convertible notes, specifically to buy more and more Bitcoin.
Can you break down what a convertible note is quickly?
Sure. It's basically a type of debt, a bond, that the holder can later choose to convert into company stock. So it lets MSTR raise cash to buy Bitcoin today without immediately diluting their existing shares. They're betting the price will go up enough to cover everything.
And now they hold almost 2% of the total circulating supply. So for an everyday investor, buying MSTR stock is almost like a Bitcoin leverage ETF.
It is. It gives you that higher geared exposure to the price movements. And this corporate trend is spreading. The analysis points to the internal talks at Microsoft about buying Bitcoin as a key trigger point.
Even though it was only partially adopted.
Right. It didn't matter. It sent a signal that led all these S&P 500 companies start seriously looking at putting Bitcoin in their corporate treasuries throughout 2025.
But the ultimate sign of maturity, the real elevation to a global asset, comes from the state level.
Right. It does. The most recent news highlights major Middle Eastern sovereign wealth funds from Saudi Arabia and the UAE allocating billions into Bitcoin mining and spot ETFs.
And that's maybe the most significant data point we have.
I think so. It confirms Bitcoin's elevation from just an alternative investment to a national strategic asset. Serious geopolitical players are now viewing it with the same importance as holding gold reserves.
This whole shift introduces a huge paradox, though. The centralization of risk. The code itself is decentralized, but the vault, the custody, is highly concentrated.
Absolutely. Over 90% of all the ETF assets, billions and billions of dollars, are held by just a few large banks and custodians. Coinbase is the biggest one.
I see the problem. That creates a new centralized risk, a single point of failure. Doesn't that just betray the whole anti-establishment idea Bitcoin was built on?
Philosophically, yes, it does. But practically, this is the price of maturity. It means a hack or a regulatory seizure at one of these huge institutions could potentially paralyze the entire institutional market. Centralization creates new vulnerabilities.
So with all this institutional money in the game, what are the new rules for investing? If the old philosophy's out, what do we follow now?
Rule number 1. Bitcoin is now a high-beta NASDAQ asset. Its price is highly correlated with the NASDAQ and U.S. monetary policy.
So the Fed's decisions on interest rates.
Exactly. You should be watching the Fed's decisions on liquidity, not just traditional on-chain metrics.
It's a huge shift. Stop tracking blockchain data and start watching the bond market.
Precisely. Rule number 2 is about volatility. Those Wild West days of 20 to 30% daily swings are being suppressed by institutional algorithms and portfolio rebalancing.
So the best strategy is
Long-term holding, HODL. Treat the big institutional purchase prices as predictable support levels for the price floor.
And finally, regulation. You said it's a moat.
It is. Regulation might be annoying for retail users, but it's the high-speed lane for institutional money. It reinforces the market dominance of compliant assets like Bitcoin and Ethereum, and it makes it much harder for other altcoins to get into those big portfolios.
So we've really synthesized two massive narratives today. On one side, you have the incredible pricing power now held by hardware producers like Samsung, all fueled by this unquenchable AI demand.
And on the other, you have the financial maturity of Bitcoin. It has successfully gone from an ideological movement to a managed portfolio asset, offering stability, but at the cost of its original decentralized ideals.
So what this means for you, the investor, is really twofold. When you're researching companies, look for that evidence of pricing power like Samsung rejecting a long-term contract. That's a true sign of sustainable margins.
And with Bitcoin, understand that your investment thesis should focus on macro liquidity and then on your vehicle choice. Do you want the stability of a spot ETF or the leveraged exposure you get from a stock like MSTR?
Right. And this discussion about Bitcoin becoming a national strategic asset raises a final provocative thought for everyone.
If powerful nation-states start treating Bitcoin as the second gold, a new kind of reserve asset, how might future political and trade negotiations be subtly influenced by the balance of sovereign crypto reserves? That's the real geopolitical game to watch.
Don't forget to subscribe and hit that like button.